cash flow statements, specifically those statements that are prepared via the indirect method. So this is actually an accounting standard, International Accounting Standard 7, which illustrates cash flows. Why do we prepare cash flows? Well, cash flows get to show you or an investor the liquidity of a company. Okay, so what do we mean by liquidity? Liquidity is just, cash, the amount of cash that a company has. And that is very, very important. Even, people who seek to invest in a given company, and it even just gets to show the managers of a company that, okay, they're able to finance themselves in here and there. Okay, that's mostly what you look at in your cash flows. So there are a few components you need to look at. Okay, how to prepare a cash flow statement. What things do you need to know? Well, actually, when you are preparing your cash flow statement, you can either start with your profit before interest and tax. This will be given in the question, or just profit before tax. The only trick is that when you start with profit before interest and tax, you have to come and subtract what? Interest. You have to remember to come and subtract interest and obviously tax. Then if you start with profit before tax, it's like interest has already been subtracted. You're only coming to subtract what? Tax. That's the reasoning behind that. So you can start with any. Just remember those rules. That's all. And that's what we'll do as we've answered this 10 question. As I said, you can start with either those two mentioned. Then the first heading is operating activities. Then you have investing activities. And finally, you have what? Financing activities. So the other question is, what goes where? Okay. So these concepts are equally even taught in that financial accounting, okay, course. Even as you are coming to approach it in your financial reporting, then you have some understanding. So operating activities, if you think, what activities in short does the company use for day-to-day operations? Operating activities, loan interests, such things. Okay, they get some profits or losses on disposal, which are not even actually cash items, but they are part of operations and they have to be treated. Okay, and then you can also, apart from those loss and profit on disposal, you also look at things like depreciation. Depreciation is a non-cash item. Okay, these are just estimates that people just, accountants, okay, get to just put in, to get to see how the value of an asset is decreasing. So such things will be talked about under operating activities, and we'll expand more as we see a question. Investing activities. Okay, what things has the company invested in? Assets that the company has bought, assets that the company has sold, dividends, such dividends being received. These are things that have been invested in. Okay, that's your investing activities. Financing activities, what does a company use to finance itself? Loans, debt, debentures, such things. Capital, of course, ordinary share capital. Okay, and of course dividend payouts due to financing. Yeah, so that's basically what you need to know. And as we look at the question, okay, we will need to actually start by following that order, if anything, as we prepare that cash flow statement. And most of the time, I've taken this approach personally as easier. The first thing is identify your cash and cash equivalents. It's very important, because these are actually what they call it. These are actual cash, if anything, cash and cash equivalents, because that's why they call them equivalents, because they're almost cash. Yeah. So what are these things? Treasury bills. Treasury bills. What else? We have short-term investments. Then we have cash itself, bank. Okay, so you have your treasury, short-term, cash, bank, and the overdraft itself, the bank overdraft. Such things are, you have cash and cash equivalents. Identify these most of the time when you're setting your cash flow. Usually we get to even compute for them in advance so that we know the total cash equivalent that the company has, so that when we prepare our cash flow statement, we get to match with what the equivalents themselves. Yeah, so when you look at the question, it all makes sense. Yeah, so let's do that. Have that question. The summarized statement of profit or loss for the year 31st October 2011 and the statement of financial position as at that date with comparative figures for 2010, okay, and for Rakton PLC are shown below. So you have that statement of profit or loss, huh? There you go. Then you have your statement of financial position for 2 years. Usually that's how a cash flow is, because you're getting to make a comparison of how your cash movement has been from maybe last year and your current year that you are preparing your statements for. Okay, that's what it was. That's what you said. As at the 2011, you're trying to prepare for 2011, but of course making a comparison with the last year. So we have that particular statement. Other additional information there below. The directors of Rakton PLC are pleased with the profit for the year of 31st 2011, but are concerned at the deteriorating liquidity position of the company. To address this concern, they are considering various options to improve the liquidity, including the raising of funds through a rights issue to existing shareholders and the issuing of loan capital. The following information is also available. So dividends of 250,000 were paid during the year of 31st October 2011. Plant and equipment with an original cost of 720. Accumulated depreciation of 540,000 was sold during the year for 210. The revaluation reserve relates to revaluation of property, plant and equipment. Long-term investment relates to shares purchased in a manufacturing company. Required. Prepare a statement of cash flow for Rakton PLC for the year to 31st October 2011 using the indirect method. Okay. Then comment on the performance of Rakton PLC for the year. So let's first solve this. Okay. Then I can just give some guidance on the comment. So what do we start with? As I said, the best approach will be identify your cash and cash equivalents, like you get to calculate for them separately before getting into your cash flow, of course, and then you can start your cash flow statement. So looking at this question, what did we say? What did we say are our cash and cash equivalents? So bank, treasury bills, bank overdraft. So let's look out for such. I've seen bank. Okay, take note of its opening and closing balances. Okay, I've seen overdraft. Yeah, it's equally there. It's at the bottom. So opening and closing, what do I mean? There is 2010, 2011. The previous year is always your opening. If you just get the gist from there, right? Then the 2011, the current year is like your closing, because that's when you're for the year ended. Okay. So like for example, bank, what's the opening? 241. Closing 0. Go to bank overdraft as the other cash and cash equivalent. Opening 0. Closing 153. Mind you, bank overdraft is actually negative cash, and I'll explain as we calculate these equivalent calculations first. So I hope we are able to see this. I said identify your cash and cash equivalents first, usually before you get into your format. So which ones were those? We picked out bank and bank overdraft. So you make like a short table like that. Opening, that's the OP I put there. CL is just closing. Then movement, I'll explain. So I've put the opening and closing as I picked them. Please just rewind the video to identify which is which. I've just stated the opening balances earlier on in the video. So once you've gotten that, your opening and your closing, you've placed them according to those columns for opening and closing. Then how do you get movement? Movement is just the difference between the opening and the closing balances. That's all. So for bank, look at why have I put the movement in negative? What does that mean? Well, the bank started with 241. That's what it shows of the opening. Closing 0. Meaning what has happened to the cash? It has decreased. So a decrease in cash is always denoted in those brackets. Okay, that's like it's a decrease. Bank overdraft. Bank overdraft, I stated something earlier on, right? This is negative cash. Why do I say that? Well, a bank overdraft is actually getting more than you have in your what? In your account. That's leaving a negative balance actually in your account. So that means, because like you're getting something on credit more than you have. So that is negative cash when you have an overdraft. So such cash automatically, when you pick it from the statements, puts in brackets denoting negative cash or already decreasing cash. So what happened? It was 0 initially and they closed with 153, which we've just coded as negative cash, means someone kept on withdrawing. So what would be the movement? If from 0 to negative, so it's still negative, right? Yeah, that's why we've put it in brackets. I hope you've gotten the concept. Then you calculate total movement. Total movement, just add the two equivalents that you have on the movement. So you have negative 241 and negative 153. That way negatives respect the signs. You get negative 394 as your total cash movement. This is what you have to prove when you draw your cash flow statement, okay? The cash flow statement is drawn in order to monitor what actually caused such a movement. That's why I said it's best to start with this. You get to denote, okay, the cash movement. Oh, we're at negative 394. Why did we land there? Okay, thus we prepare a cash flow statement to come and match to this figure, and we'll be able to understand, okay, this happened, that happened, and the like. So I'm about to show you how to start this particular cash flow and of course the necessary computations. So basically, this is the format we're starting with there. As you can see, some entries are being put there, and I'll be, of course, adding some explanation. So you put the heading cash flow statement for the year ended as of that date. Then, as I said, you can either start with your net profit before what? Net profit before tax, okay? Or net profit before interest and tax. In this case, I started with net profit before interest and tax. So let me just get back the question so that you can be seeing how the figures are being picked and the like. So I had showed you a certain net profit figure, right? So we picked the one from 2017, 2011. Why 2011 and not 2010? Well, we're preparing the cash flow for the end date 2011, and what we are supposed to pick are the current year figures there. So we picked 806 because we've started the cash flow with profit before interest and tax. Okay, so one way you can start your cash flow. So 806 is there. Then the first thing that you adjust, first of all, are what they call non-cash items, which were depreciation and profit on loss on disposal if they are there and the like. So is depreciation there? No, but you have to find it. The depreciation charge for the year that we usually record in your profit or loss statement, even though you're not seeing it in the question, it's a must calculation, because how do you know that it's actually there? Check your financial position there. There is something about depreciation, so you know, of course, they've given you the overall depreciation as of the financial position, the balance sheet, just to show you the total accumulated dip. Now you're trying to look out for that charge for the year that of course was affecting your profit, because it's there in the profit or loss statement. So basically we have to look for that charge, and I'll demonstrate. Then profit or loss on disposal, how do you usually find out that it's there even though it's not showing? Go to the adjustments there. You would see adjustment number 2 specifically is talking about plant and equipment with an original cost of 720,000 and accumulated depreciation of 540 were sold during the year for 210,000. The revaluation reserve relates to revaluation of property, plant and equipment. Okay, just that detail shows us that they sold, meaning you can test for a gain or a loss. Gain is just a profit. So I'm about to share a screen for depreciation calculation and profit or loss, because these two are what they call non-cash items that have to be adjusted first from your net profits. Then of course you proceed as per format as I'll be demonstrating. So just before we go to the screen where I'll share the calculation, as we calculate the charge, we are much more focused on these accumulated depreciation values in the balance sheets. Okay, so you have, okay, although they are looking mumbo jumbled, but that 3209, if you can see it in 2011, that's just the balance, the closing balance in the depreciation account, total balance. And then that's 2852, if you can see it, that is your opening balance in the depreciation account. So mostly, as I said, they give you 2 years. The previous year is your opening, the current year is your closing. So these double ways are there, you know, to get to see the movement or any changes from the previous year to the current year. So I want to get the charge for this year. Okay, and as we even handle this depreciation, we will need some detail from part 2. very important, that accumulated of the asset they are selling, because you have to take into consideration of that asset, so that in the end you get an accurate depreciation charge for the. So adjustment 2 will work very much as we even calculate the profit on disposal and also the charge for depreciation. So I've positioned those opening and closing balances. Okay, the 2852, which I said is the opening, and the 3209, which I said is the closing, because it was in 2011. So why have I put them at those sides? 2852 opening balance, a depreciation account as a credit balance by nature. So we put our opening on the credit. Closing, at the end of the day, it's equally supposed to come and close on the credit as well. But for the sake of computation, we get to record the carried down first. Okay? Because when you carry down, it's the opposite side, and then brought down or go where? The credit, of course. But we are focused more on the carried down for easy computation, and you even see why we leave it here. Then what else goes in a depreciation account? If an asset is being sold, you have to record it on the debit side, showing what? A reduction in depreciation. That's why they record on the debits, because an asset is being sold off, the depreciation will reduce. When depreciation is being charged more, we credit more. That's it's increasing. So you're looking for the charge, and we said this account will help you. How do you get it? So basically what you're going to do is that you're trying to balance off this account and solve for X, because the charge for the should appear on the credit side, because as you charge more, as I said, it will be appearing more on the credit because you're increasing. So what you just do is that get the total, and find that X by the missing figure. How do you do that? You can add these two, follow that arrow, and then you can subtract with what? This opening balance you're seeing there. Therefore, the charge will be 897. That's how you get depreciation. Huh? Look at the next one. How do I test for profit or loss on disposal? Well, get back to your knowledge on disposal accounts. Those accounts are very key, okay, when getting to calculate whether you have a profit or a loss on disposal. So a disposal account gets to show you whether you make a profit or a loss. What goes in the disposal account? The cost of the asset being sold. I've debased the figures, mind you. They were 720,000, but I've just removed the last 3 zeros. So 720, that's the cost, which is take on the debit side of the disposal account. These are just formats. Then on the credit, you record the accumulated dip of this particular asset being sold. I hope you're listening. Then you also record the cash value that you're selling this asset for. Okay, then thereafter you can test for what? Profit or loss on disposal. Profit goes where? Here. We have put an X. What about loss? Loss will go where we have put letter Y. These are just letters just to show you. Profit goes where there is letter X, and loss goes where there is letter Y. So in this case, you would find that the credit was actually larger than the debit, right? So if the credit is larger than the debit, meaning you have a what? A profit. Why? Because the shortage is on the debit side, and we said that X which is on the debit side, then you have a profit on what? On disposal, and you put a 30 there. That's your profit. That's M30. So you can now go and record them in your what? Statement of cash flow and proceed from there. That's it mostly there. So I'll show you how we'll now record this. We are back to the same question, or the screen which had the solution here. Depreciation 897, you saw how we found it. Positive. Why positive? Signs are very important in the cash flow statement, please. Depreciation is being added back. Why? Depreciation is a non-cash item, and depreciation is treated as an expense, if you remember in your statements of profit or loss. But you are being told that that's a non-cash item, and it's reducing your cash, because expenses do reduce your cash. So add it back so that it's not giving you a wrong picture of your cash. So we add back. Looking at profit or loss on disposal, we said these two, this one equally is a non-cash item. Look at the heading. I even put adjustments for non-cash item. Okay, profit on disposal, it's a non-cash item, by the way. So a profit, what was it doing? It's treated as an other income, but it's subtracted. Okay, those things are non-cash items, as I've just said. If it's increasing your incomes, then it's also showing that your cash has gone up. But they've told you it's a non-cash item, meaning reduce it, remove it. That's why it's in brackets, to show subtraction. So we just get to get this simple concept that all expenses which are non-cash we add, all incomes which are non-cash we subtract. That's all. That's what I've done. and then you get to compute like that. We didn't have accruals, we didn't have prepayments, we just move on and sum up. Of course, I got 867 after treating dip and of course the profit or loss. I got 867, which I added up with my profit before interest and tax, and I got 1673. We're moving. Working capital adjustment. Working capital adjustment. What is your working capital? Well, we get back again to our financial accounting. Okay, so what is working capital? Current assets minus current liabilities. Okay, those current assets, we know them: inventory, your trade receivables, such things. Then your current liabilities. What do you have in current liabilities? Majorly in the cash flow, look at trade payables mostly, but there are many more, but we get to just look at trade payables. So let me show you how we're arriving at those figures. It's pretty easy, but let me just demonstrate. So let's start with the current assets part of that working capital. So in the current assets, equally in the cash flow, we only look at inventory, cash, and also inventory and trade receivables. Those are our prime focus. So look at inventory. 2010 to 327, right? 2011, what's the figure? 315. What has happened to inventory there? It has decreased, right? Decreased by how much? 12. What does a decrease in inventory mean to your cash? These are the questions you should be asking yourself in the cash flow, because cash flow is about cash. Okay, what is happening to your cash? So if inventory decreases, what does that signify? Well, a decrease in inventory gets to show you that what you have sold off, of course, some stuff. Okay, I hope we are moving together on this one. A decrease in inventory shows that we have sold off some stuff, meaning we have received cash for what has been sold. Of course, if your stock has gone, meaning you've sold, right? And if you sold, cash has come in. So that 12 change there has to be positive, because it's a cash injection. Then trade receivables, 598 to 657. What does that mean? Receivables have gone up. Your debtors have increased. In short, people who owe you money. Well, if people owe you money have increased, it's actually a deduction in your cash. Why? Your inventory is showing you in the company that your inventory has done what? If people buy on credit, then it's showing that, okay, your stocks have gone down somehow. But debtors, have they paid you? No. They're holding on to your cash somewhere. So you as a business, what happens if your debtors are increasing? It is actually a decrease. Okay, it's recorded as a decrease in cash for the fact that money has not yet been paid back, but stock is showing that it has gone out. Okay, look at the next particular working capital adjustment, which is trade payables. We look at specifically under the liabilities section. Trade payables 618 to 659. Trade payables have increased as well, okay, by about 41. Yeah, so that just simply means there that if your payables are going up, people you owe money, that is a good thing. Why? No cash has gone out yet. You've just holding on to things you've borrowed. You have not actually paid. So as long as cash has not left the business, you still have cash. So that 41 change is positive. You want to say negative cash because you haven't yet paid. As long as payables keep going up. And that's how you sort out the working capital adjustment part. Let me show you how I've done it. So you get to see that working capital adjustment, I've put 12 for inventory, I said positive. If you hear my explanation, I've kept it positive. Inventory, okay. Receivables, I said negative cash. Why? People have taken your goods, they are increasing. No cash has returned yet because they're holding on to your goods. It's put as a negative figure if there's an increase in receivables. Trade payables, we just explained that 41 change will be positive because you haven't paid out people you owe. And then you sum up respecting their signs. If one is negative, say 12 minus 59 and then 41. So you have done that. We got a 6 in brackets from those working capital adjustments. By the way, that's 12 minus 59 plus 41. You get negative 6. Add up to that 1673, which is up there, and you get 1667, following the signs as I've said. Then the next stage is less tax. Okay, we are still under operating activities. We're not done. The last stage is actually less tax and interest payable. Okay, so tax is some computation. Always get this part right. We just don't pick any tax figure that you see in the original question and put. No, there's some computation that we use, and I want to demonstrate. Interest payable, at least it was 16. Just pick the figure in the current year we're doing this for, which is 2011. That's why I picked the 16 there. Let me just show you for tax. So look at tax there, right? Then they've said there's tax there 172, there's tax 191. Okay, one would be like, why can't we just equally pick the tax in that particular year? So tax, what happens is that we just don't pick it exactly, because if you've noticed, just a minute before I pick, this is where the statement of financial position, right? Start with, first of all, looking at the taxation figures as well, even up there in the statement of profit or loss, then I guide you. So the current year's tax as of 2011, right, is 184. Okay, that's what we only pick. Okay, the current year's tax. So we want to know, okay, 184. But just before we go ahead, usually taxation also shows or comes to appear in your statement of financial position, which is the balance sheet, as you can see below, tax payable. So what happens is that, okay, it's showing us that the payable in 2011 is 191. Okay, and then the year's charge is 184. So you have to like open a T account. So you open a tax account, as I said, a T account, if anything. Okay, want to take note of those particular balances from that balance sheet. We had two. One was an opening, as we said. When we see a previous year, it's like an opening. And for tax, we usually get to choose the opening and closing from the balance sheet, because you know it's a financial position. Just show you the current position of the company based on those particular, of course, liabilities like tax. There shows you that, okay, there was that closing of like 197. That was like the closing as of 2017, and then it had an opening as well. Let me just quickly confirm those figures. It's actually 191 as a closing and 172 as your opening. A tax account is a liability account, so the opening is always on the credit. Then the profit or loss, please take note of this. A profit or loss statement just shows a charge for that year. Okay, so we just get to pick the particular charge as of the year we're preparing this for, which showed us as 184 as a charge for tax. And then try to balance this off as well. Okay, and mostly the shortage will be this side from how I've seen it. The shortage is what you would post as your tax, the tax that you should record in your cash flow after taking note of the previous year, current year, and the current previous year, of course, and the year's charge, of course, which was 184. And then you get to compute the tax that you should be recorded in your cash flow statement, which will give you, I think, 165. And that's it. That's your tax computation. And then you go and record under those items that we're saying less tax and less interest. So that's the 165. Why have I put it in brackets? Of course, we are less in tax. Tax is a decrease in cash, in other words. That's why we come to less tax. Interest payable, equally, we come to say less, and that's the 16, which we found as well in your profit or loss statement was 16. And equally negative because these are expenses. Then, of course, I summed those up, 165 and 116, they gave me negative 181. And I less it from 1667, giving me a total net cash from operating activities of 1486. That's just operating activities. So the next part of this video actually will focus on investing activities till the end of the cash flow. Okay, just put them in parts, if anything, these two videos.